Something enormous is happening in global finance, and almost nobody is watching. Not because it is hidden, but because it is boring. Trillions of dollars are coming due, quietly, mechanically, on schedules written years ago. This is not a crash. This is not a panic. This is a rollover. Governments around the world must refinance old debt at rates that no longer exist. Cheap money is gone. Zero is gone. The system was built assuming it would never return. Now the bills are arriving anyway. Here is the part people miss. This exact setup has appeared before. Different countries, different decades, same sequence, same pressure, same ending. When debt matures faster than growth, the math takes control. Politics stops mattering. Narratives stops mattering. Only refinancing capacity matters. We are already past the first stage, the comfort stage, where refinancing looks routine. Auctions clear. Headlines stay calm. Officials speak confidently. That stage always looks safe. It always feels manageable. It never is. The second stage is where we are now. The rollover expansion stage. Old bonds issued at 1% are being replaced with bonds at 4, 5, 6%. Not all at once. Gradually, invisibly. Each auction slightly more expensive than the last. Each maturity quietly resetting the future. Nothing breaks immediately. That is why nobody panics. Budgets absorb the increase. Deficits widen slightly. Central banks stay patient. Analysts call it manageable. They always do. But rollover debt compounds differently than new spending. You cannot cancel it. You cannot delay it. You cannot negotiate with it. It arrives on schedule and demands replacement. If the rate is higher, the system accepts it or fails. This is where the trap forms. Governments are not borrowing to build, they are borrowing to survive. New debt does not expand capacity, it preserves continuity. That distinction matters. It always does. The third stage begins when rollover volume overwhelms discretion. When too much debt matures in too short a window, when markets realize issuance is no longer optional, it is mandatory. Buyers sense that necessity, pricing power shifts, yield demands rise, liquidity thins. You can already see the signs: auction tails widening, bid-to-cover ratios weakening, primary dealers absorbing more inventory than they want, balance sheets tightening quietly. Officials respond the same way every time. They downplay, they smooth, they promise stability, they frame higher rates as healthy, they call it normalization. This is not normalization, this is arithmetic asserting itself. The final stage never arrives as a single event. It arrives as a loss of flexibility. Choices narrow. Policy becomes reactive. Printing becomes tempting again. Not because it works, but because nothing else does. This is the global debt rollover crisis, not a headline, not a shock, a process. Already underway, already irreversible. We are only at the beginning of its consequences. The pressure has not peaked, the adjustment has not finished. What comes next follows the same pattern. It always does, and it never stops halfway. Once momentum takes over, systems bend. What makes this phase dangerous is not scale, it is timing. Trillions are not maturing randomly. They are clustering. Years of synchronized borrowing during zero-rate policy created synchronized expiration windows. The system optimized for cheap money efficiency, not staggered resilience. Now those decisions are converging. This is where rollover pressure becomes systemic. When one country refinances at higher rates, it is manageable. When many do it simultaneously, capital must choose. Global savings are finite. Buyers prioritize yield, safety, liquidity. Someone is always pushed to the margin. That is when stress migrates. The first migration is invisible. Pension funds shorten duration. Banks reduce balance sheet exposure. Foreign holders quietly slow purchases. Demand does not disappear. It becomes conditional, price-sensitive, unforgiving. Then comes the signaling problem. Governments cannot openly admit rollover dependence. Markets cannot openly ignore it. So both sides speak past each other. Officials emphasize confidence. Markets emphasize compensation. The gap widens. At this point, central banks re-enter the conversation. Not with announcements, but with posture. Balance sheet runoff slows. Liquidity facilities quietly expand. Language softens. Data dependence becomes an excuse for delay. This is not coordination. It is containment. The problem is that rollover math does not respond to containment. It responds to rates and volume. Each maturity resets future obligations at current conditions. The longer higher rates persist, the deeper the structural shift becomes. This is why inflation falling does not solve the problem. Growth slowing does not solve it. Recession does not solve it. In fact, downturns accelerate rollover stress by reducing tax revenue while refinancing costs rise. Eventually, a threshold is crossed, not when debt becomes too large, but when refinancing absorbs too much fiscal space. Budgets stop being flexible. Emergency responses become permanent features. Political conflict intensifies because there are no easy cuts. This is where the illusion of control breaks. Governments face three options: raise taxes, cut spending, monetize. Each one has consequences markets already understand. That understanding is priced in before choices are made. This is why volatility remains suppressed even as risk rises. Participants are not confused. They are waiting. Waiting for confirmation. Waiting for policy mistakes. Waiting for the moment rollover pressure forces visible action. The crisis does not announce itself. It reveals itself through constraints. When stimulus no longer stimulates. When tightening no longer tightens. When every tool produces diminishing returns. This is the stage where narratives shift quickly. What was called temporary becomes structural. What was framed as resilience becomes strain. What was dismissed as alarmism becomes consensus. The global debt rollover crisis will not look like past crashes. There will be no single trigger, no single villain, no single date. It will look like stability slowly losing credibility. We are not there yet. But we are moving in only one direction. The schedule is fixed. The maturities are known. The rates are higher. The math is unavoidable. What happens next follows the same pattern it always has. The only question is how long denial lasts before adaptation begins.